Hello, everyone, and welcome to another episode of the Wealth Breakdown Podcast, where we give you practical applications that you can use with your CPA, with your financial advisor, or with us if you happen to be a client. We'd love to have you. Today, we are going over a case that I just got done with. I am going to redact the real client names, of course. But this one was really fun because we used a relatively simple tactic called a Roth conversion to create what could be multi-generational wealth for a client. So here's the situation. We've got John, who is a 55-year-old business owner who started a business 3 years ago, is still working through startup costs, and is just now starting to really hit revenue. And he has about 400,000 of carry forward losses, which can be used to his benefit to offset gains or income for tax purposes. So what is a Roth conversion? So to start, you need to know the difference between a traditional IRA and a Roth IRA. In a traditional IRA, the money that you put in up front, you get a tax deduction for. Then it grows tax-free in the account. And when you hit retirement age, you can take the money out, but you have to pay income tax on that money. With a Roth, it's the opposite. You use after-tax money to contribute up front, but then you never pay tax on it again. Roth IRAs also, you aren't required to ever draw from a Roth IRA. With a traditional IRA, once you hit a certain age, you are required to start drawing from that. So that income tax on the traditional is unavoidable. To use a farming analogy, a traditional IRA is like getting a tax break on the seeds that you plant, but then being taxed on the harvest once the seeds have grown into full-fledged plants. A Roth, you get taxed on the seeds that are put in, but the harvest comes out tax-free. So let's walk through how we found this. So as part of my process, I always get tax returns. So one of the first things that I noticed on John's tax return is that he had about 400,000 of carry forward losses. And then I immediately thought, does he have a traditional IRA? Because if the carry forward losses are net operating losses from a business that flow through to the business owner personally, if the business is an LLC, then those can be used to do what's called a Roth conversion. So going back to the farming analogy, many of you listening will likely think, oh, well, the getting taxed on the seeds, but not the harvest sounds like a way better deal. And to many people, it is. Everyone's situation is different. For some people, it may be worth getting the tax deduction for traditional IRA and maybe converting at a later date. Roth conversion isn't for everyone, but when we have a way to convert what, in this client's case, is 300,000 of traditional IRA, which will be taxed at the end, the harvest on that will be taxed. By using those losses, we can convert that into something that will never be taxed again without him paying income tax. When you convert from that traditional IRA into the Roth, the IRS knows that and says, hey, if you're going to make this conversion into this vehicle, we're going to take back that deduction and it's going to be income tax for this year because you're getting the benefit of never having to pay tax again. So the IRS has to get you somewhere. So they get you on the conversion. But if you have the carry forward losses, you can use those to offset the income that comes from that conversion. So I worked with the CPA We ended up converting around 350,000. So, well within those carry forward losses. So let's walk through the math here. So it does take some skill on the part of myself, my team, and the CPA to identify that it's a kind of loss that can be used for this purpose and to actually execute it properly. So, the value of executing that properly is around $126,000 because if it's not, that would be taxable income. And that would put this client in a high tax bracket because he is single. It would put him in the highest tax bracket. Um, then we look at this is the real magic of the Roth conversion when you can do it the right way. This is now going to compound over time tax free, not just over the client's life expectancy, but then 10 years into the person that inherits the Roth IRA. Because you do have to, if you inherit something like an IRA, you have to distribute all of it within 10 years. But since it's a Roth, you might as well just have it grow tax free all 10 years and then distribute it all. So if the now Roth IRA compounds from present time to John's retirement, he's currently 55. I use 70 as his retirement age, so that's 15 years. The contributions grow to 20, the contribution portion of it, if he continues to max, grows to, anywhere from 244,000 to $1 million based on, historical S&P 500 rate of 8%. The market does not always generate 8%, but historically over long periods of time, that's what it does. So that's the number that we'll be using. Then if we look at the IRA, the basis that's already there, compounding from retirement, so that 15 years, plus then the 10 years for the person that inherits it, it could be anywhere from, if John lives until he's 85, that could be $8 million. If John lives to be 95, that could be $18 million. And then if we think about the 126,000 that we saved by executing this properly in tax payments, that compounded over time could be anywhere from 1.2 million to 2.7 million, depending on how long John lives. So what we end up with is some credit to be given for executing it properly, which, it's fine, but we technically didn't save the client anything because those losses were just there to be used. But then the value over time, of anywhere from 8 to $20 million potentially left to beneficiaries is incredible. 8 million to 20 million today is not going to be the same as 8 to 20 million tomorrow, but I think we can all agree that it is still substantial. And including that long-term market investment tends to outpace inflation. So there's also that. So this is just a prime example of why you need planning as a client of a financial advisor, in addition to just investment management. There's no investment that's publicly traded or privately traded that can beat the return on investment on time and on effort that we just got for this client. So, if this is something you're interested in, I'm always happy to do free analysis. We only work with clients where we can deliver massive value, and it's really a pretty no pressure process. So reach out. We're always happy to do free analysis. And if it works out, it works out. Otherwise, no pressure. We'll see you on the next one. Thank you. If you found this valuable or applicable, please click the Contact Us button below to answer a few simple questions and get scheduled with a Bloomwood advisor to discuss your unique situation. The information covered and posted represent the views and opinions of the guests and does not necessarily represent the views of Bloomwood. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for financial, legal, or tax advice. Always seek the advice of your financial advisor or other qualified professional with any questions you may have. Bloomwood is a Georgia and North Carolina registered investment advisor with its principal place of business in Atlanta, Georgia. Bloomwood and its representatives are in compliance with FINRA and state regulation in the states where Bloomwood maintains clients. Bloomwood may only transact business in those states in which it is registered to do so or is exempt from registration. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same result. This content does not constitute tax advice, legal advice, or financial advice, and does not create an advisor-client relationship between Bloomwood and the listener. This case study is designed to give you an overview of the impact that proper tax and financial planning can have on your financial life. The figures in this case study are not calculated to the exact penny and are designed to facilitate a conversation. Thank you.